Hi everyone, today I'd like to do a recap of what I learned on the fourth session of corporate finance class by Professor Roy Sembel at ITMI International Business School. So the first thing we learned about was portfolio theory by the Nobel Prize winner Harry Markowitz. It is a it is a theory used to assemble a portfolio of assets to maximize expected return for a given level of risk. It is a diversification of investing. The idea of owning different kinds of financial assets is less risky than owning only one type of asset. Some important points are about returns and risks, as well as correlation and diversification. There are three types of returns, which are potential return, actual return, and required return. Total risk is the standard deviation of variance of return. Systematic risks are those that we cannot reduce using diversification. A good example is the COVID-19 pandemic affecting all companies. Unsystematic risks are those that we can mitigate by the means of diversification. Example is fire in the office or in a factory affecting only one company. Diversification is a technique used to reduce risk by allocating investments among various financial instruments to maximize returns by investing in different areas that would react differently to the same event. Correlation is a statistical measurement, a linear co-movement. The lower the correlation, the better the diversification. The unsystematic risk can be mitigated even more when the correlation is low or negative. We also learn about capital asset pricing model by William Sharpe, which is a model used to determine a required rate of return of an asset to make decisions about adding assets to a well-diversified portfolio. According to this theory, the price of return is based on systematic risk, where the higher the systematic risk, the higher the return. We also learn a bit about capital structure, which is the combination of debt and equity used by a company to finance its overall operations and growth. That's it for today. Thank you.